Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're going deep into the world of commodities, specifically gold and silver. If you've been wondering how to invest in gold and silver, or if commodity trading is worth exploring as a new investor, this episode is for you. I'm going to walk you through everything you need to know, step by step. No fluff, just the insights and strategies you need to get started the right way. So let's dive in. Now, why do commodities matter? Why should you, as an investor or trader, even pay attention to them? First of all, gold and silver have been stores of value for thousands of years. Unlike paper currencies, they aren't printed by central banks, and they tend to hold their value when inflation rises or when economic uncertainty makes the stock market volatile. They're seen as a hedge. They give your portfolio that stabilizing weight when everything else is spinning. Second, commodities help diversify your portfolio. Stocks and bonds are great, but they often move in sync with economic cycles. Commodities, especially precious metals, tend to move on different rhythms. That means they can act as a counterbalance, especially when markets get choppy. And third, they serve as an inflation hedge and safe haven. When central banks start printing more money, or when interest rates stay lower than inflation, people flock to gold and silver. When geopolitical tension rises, people rush to metals. They're safety plays. Let's break down how to invest in gold and silver, starting with your options. Option 1, physical ownership. This is the most direct way. You can buy gold or silver coins, bars, or bullion. You hold it in your hand or store it in a safe or vault. Pros? No counterparty risk. It's real. Cons? You need secure storage, possibly insurance, and it's not as easy to sell quickly. There's also professional vaulted storage, where institutions store your metals securely and insure them. You still own the metals, they're just kept in a high security location. Look for allocated storage, where your specific bars or coins are identified and held for you, not pooled with others. Option 2, ETFs and funds. This is popular because it's easy. Gold and silver ETFs like GLD or SLV track the spot price and can be traded just like a stock. They offer liquidity and low cost. You get exposure to the metal without physically owning it. However, keep in mind that you pay a small management fee, and some ETFs have tracking errors, meaning they may not perfectly follow the metal's price. Option 3, futures contracts. This is where things get riskier and more complex. Futures allow you to agree to buy or sell a certain amount of gold or silver at a future date. They offer leverage, so a small move in price can lead to large gains or losses. These are tools for experienced traders. If you're new, proceed with extreme caution. Option 4, mining stocks and funds. Rather than investing in the metals themselves, you invest in companies that mine gold and silver. These stocks tend to have more volatility because they're influenced by company performance, production costs, and management. But they can outperform the metal in bull markets because they're leveraged to rising prices. Now, let's talk about commodity trading for new investors. First rule, manage your position size and risk. Don't go all in on one trade. Don't overleverage, especially with futures or margin-based ETFs. Start small. Get a feel for how prices move and how volatile these markets can be. Second, research macro trends and seasonal cycles. Gold and silver prices respond to inflation, interest rates, central bank policies, and geopolitical headlines. For example, if the Federal Reserve signals it's pausing rate hikes, that's bullish for gold. If inflation data comes in hotter than expected, that supports metals too. Silver also has industrial uses in solar panels, electronics, and medical applications, so it can move on economic growth news as well. Third, risk management is everything. Use stop losses. Define how much you're willing to lose before entering any position. Never risk more than 1 to 2% of your portfolio on a single trade. Fourth, stay emotionally disciplined. Don't chase. Don't panic sell. Stick to your plan. And fifth, watch your fees. Use platforms with low spreads, low ETF expense ratios, and avoid buying physical metal from overpriced dealers. So, how do you actually get started? Step 1, educate yourself. Start listening to high quality content. The Crystal Ball Markets podcast is one of the best out there for beginners. It covers macro trends, trading insights, and real world strategies you can apply right away. Highly recommend checking it out at our ss.com/podcast/crystalballmarkets. Step 2. Choose your access method. Do you want to own physical gold? Trade ETFs? Buy mining stocks? Trade futures? Pick one or two and go deep before adding complexity. Step 3. Pick your platform. The platform you use matters. A clean, fast, intuitive interface can save you time and reduce mistakes. One I recommend is the Crystal Ball Markets trading platform. It's world-class, user-friendly, and packed with tools to help you trade smarter. Check it out at crystalballmarkets.com/platform. Step 4. Build your trading or investing plan. Decide how much you're investing, what your targets are, how much risk you'll tolerate. Set rules for rebalancing, and write it all down. Step 5. Practice. Use a demo account. Test your strategies. Look at historical data. Learn how metals respond to economic news. Step 6. Start small. Make a small trade. Watch it. Track your emotions. Track the price. Learn from it. Step 7. Review and improve. Markets change. So should your strategy. Track your results, stay informed, and adapt. Let's talk portfolios. Here's a conservative allocation model. 60% in a gold ETF, 20% in a silver ETF, 10% in a mining ETF, 10% in cash or bonds. For balance, this gives you core metals exposure without overloading any one asset. Want to be more tactical? Go physical for your core holding, trade mining stocks during bull cycles, and layer in short-term trades based on macro triggers like CPI or Fed meetings. Let's dig into what moves metal prices. Interest rates matter. Higher real interest rates, that's interest minus inflation, hurt gold. Lower real rates support it. Inflation expectations? The higher they go, the more valuable metals become. Currency strength, especially the US dollar, also affects price. A weaker dollar often means stronger gold. Central bank buying and geopolitical stress? Those are demand drivers. If a central bank ramps up gold reserves, or if a war breaks out, safe haven demand spikes. Silver also has industrial drivers. Demand from tech, energy, and medical sectors adds volatility and opportunity. Now, let's touch on taxes, storage, and security. Tax treatment varies. Some jurisdictions treat gold ETFs differently from physical bullion or mining stocks. Always consult a local tax professional. Keep documentation. If you buy physical, save receipts. If you trade ETFs or stocks, download your statements. And for storage, either use a home safe with insurance or a professional vault with independent audits. Never store large amounts of metal without a plan. To stay sharp, follow market news. Track key data points, inflation reports, Fed announcements, geopolitical headlines. Watch price levels and technical zones. Learn chart patterns. Monitor macroeconomic shifts. And again, I highly recommend the Crystal Ball Markets podcast. It breaks down all this info in plain English and gives you real examples. Visit our ss.com/podcast/crystalballmarkets to stream new episodes. Also, if you want to trade gold, silver, or commodities on a clean, cutting-edge platform, try Crystal Ball Markets. Their platform is smooth, user-friendly, and built with traders in mind. You can sign up today at crystalballmarkets.com/platform. So what's the bottom line? Gold and silver are powerful tools in your investing arsenal. They offer protection, diversification, and real-world utility. Whether you're looking to hold them long-term or trade them short-term, the key is to stay informed, use the right tools, and manage your risk. Thanks for tuning in to this episode of Financial Market Insights for Traders. I'm Sophia, and I'll catch you next time.